Several central banks are reviewing their monetary policy strategies and tactics at the moment, and critics are questioning whether inflation targeting is still the way to go. Welcome to Business, the new podcast from the Bank for International Settlements. I'm Krista Hughes, and here with me is the head of the Monetary and Economic Department, Claudio Borio, to explain the particular challenges facing emerging market central banks. Claudio, there's a special chapter in the annual economic report about monetary policy frameworks. Why are these such a hot topic at the moment?
After the global financial crisis, there has been quite a lot of soul-searching within the central banking community in advanced economies because they had to adopt unconventional monetary policy measures and inflation was stubbornly low. Emerging market economies fared considerably better, but at the same time they had to deal with the consequences of spillovers from advanced economies which had kept interest rates low for long.
What are the challenges that these central banks face compared to their counterparts in advanced economies?
The key challenge emerging market economies face is that they're more exposed to global financial conditions. Like advanced economies, they borrow heavily in international capital markets, both in foreign currency and increasingly in domestic currency. But unlike their advanced economy counterparts, they don't have well-developed markets in which you can hedge exchange rate risk, and they have less of a developed institutional investor base. As a result of that, they're more at the mercy of the ebbs and flows of risk-taking in global financial markets, and they're more exposed to spillovers from US monetary policy, which has a significant impact on risk-taking in global financial markets because the dollar is the dominant international currency.
What kind of approach have they developed to deal with these challenges?
Well, if you go back to the crisis that they had in the mid-1990s, they moved away from relatively inflexible exchange rate regimes and they adopted inflation targeting. At the same time, they didn't move all the way to have freely flexible exchange rates. And they combined inflation targeting to varying degrees with forms of foreign exchange intervention. Now, this is in contrast to what you can find in textbooks, in standard textbooks. So you could say that practice moved ahead of theory. And in some ways, this is reminiscent of what happened in the early 1990s when some advanced small open economy moved away from the regimes that they had and adopted inflation targeting to start with.
Why do exchange rates matter so much to emerging markets?
They matter because of the fact that you cannot hedge foreign exchange risk so easily. There are imbalances between assets and liabilities in foreign currency. And this makes them quite sensitive to changes in the exchange rate. This applies both to the balance sheets of lenders and to the balance sheets of borrowers. As a result of that, changes in the exchange rate can generate changes in financial conditions in those economies. In particular, for example, if you take an exchange rate appreciation, that loosens financial conditions in those economies. You can call this relationship between changes in the exchange rate and what happens to the balance sheets as the financial channel of the exchange rate.
And what does this mean for the central bank?
It worsens the trade-offs that central banks face. On the one hand, it makes it harder to stabilize both inflation and output at the same time. In the traditional case, what we call the trade channel, a depreciation of the currency raises inflation but boosts at the same time output because it increases exports. On the other hand, in the case of the financial channel of the exchange rate, a depreciation of the currency does raise inflation but contracts output. And this opposite movement makes it very hard for the central bank to decide whether to raise or to reduce interest rates. At the same time, there is also another trade-off, which is it becomes harder to reconcile macroeconomic price and financial stability today with macroeconomic price and financial stability tomorrow. That is because the financial channel amplifies surges and reversals in capital flows, and it also turbocharges financial booms and busts domestically in the form of very strong credit and asset price increases that are then followed by similar reversals.
How does FX intervention help break this cycle?
Well, it helps because by muting the change in the exchange rate, it also mutes the financial channel and it helps because it allows central bank to build foreign exchange buffers to deal with the risk of the potential reversal in capital flows and associated large depreciations of the exchange rate.
And what's wrong with relying on FX intervention?
Well, it is not a panacea, and it has to be used wisely. There are a number of costs and limitations of foreign exchange intervention. One and most obvious one is that its impact on the exchange rate is temporary, so that if you want to have a longer lasting effect, you have to use it repeatedly. Another cost, which is related to the previous point, is that if you have large foreign exchange reserves, there are carrying costs to them because the return on the assets in which you invest are typically lower than the cost of the liabilities with which you finance those foreign exchange reserves. And the third type of cost is that if you use foreign exchange intervention very heavily, you could provide markets with a sense of insurance, and you could also do away with a sense of two-way risk. The idea that the exchange rate could go up and down as opposed to just in one direction. That would, in the longer run, would generate or at least contribute to those currency mismatches that are at the source of vulnerabilities in the first place.
Is that why other tools are typically used as well?
Absolutely, and a typical tool which is used in that context is macroprudential measures. Macroprudential measures can deal with some of the financial imbalances, domestic financial imbalances that I mentioned earlier in the form of strong credit growth and strong increases in property prices, but they can also target currency mismatches more directly. Now, these macroprudential tools, as a result, they tend to improve, to strengthen the resilience of the financial system, and they can also help to some extent to constrain the buildup of financial imbalances. So the bottom line is that you need a more balanced policy mix.
Does it matter if central banks use a patchwork approach as long as it works?
Well, you could say that the proof of the pudding is in the eating, and so far I think that these frameworks have performed rather well. Inflation has generally declined across these countries. Output performance has been quite good. You haven't seen any financial crisis. At the same time, of course, you have also seen rather strong credit expansion over the last few years in quite a number of those economies, and this involves risk going forward. I would say that there is still quite a lot to learn, particularly in terms of how one would use these instruments most effectively. And here again, what is missing is a rigorous analytical framework that could help us put the various pieces of the jigsaw puzzle together, and that would provide a measure of intellectual comfort. But the direction of travel is very clear.
Thanks very much for joining us, Claudio, and thanks everyone for listening in. If you're interested in the work of the Bank for International Settlements, please do look at our website, bis.org, and follow us on LinkedIn, Twitter, and YouTube.